So get this, there's a company called Strategy that made a bet on Bitcoin so huge, they now hold over 3% of all the Bitcoin that will ever exist. I mean, it's just a massive position. The problem? Well, that $54 billion bet is now deeply underwater. So what happens next? Let's figure it out.
Okay, first things first. Let's just wrap our heads around the scale of this problem. Strategy bought its mountain of Bitcoin at an average price of just over $76,000 per coin. Just keep that number in your head.
Now, you compare that to where Bitcoin's trading today, kind of hovering in the high 60,000s. The math is, well, it's pretty simple, and it is not pretty. The biggest corporate Bitcoin holder on the planet is officially in the red.
And that brings us right to the big question, doesn't it? With billions of dollars in paper losses, is this company about to trigger some kind of crypto apocalypse? Or is there maybe a little more to the story? We're about to find out.
So let's really try to understand the sheer scale of this whole thing. This isn't just, some company dabbling in crypto, adding a little to their balance sheet. No, this is one of the biggest, boldest financial experiments we've seen in years.
Wow. Okay, this slide really puts it into perspective. Strategy's holding a staggering 717,131 Bitcoin. That's 3.4% of all Bitcoin that will ever be mined. That is a huge slice of the entire pie. And that huge slice came with an equally huge price tag, $54.5 billion. And right now, that translates to an unrealized loss, a paper loss, of almost $6 billion. That's the kind of number that puts an insane amount of pressure on any company.
Now, all this pressure led to a headline that sent a real chill through the market. It was all about a single number, a number that came from the company's CEO, and honestly, it's been widely misunderstood. So let's break down what everyone's calling the $8,000 myth.
So here it is. This is the quote that sparked all the panic. The CEO said that Bitcoin would have to absolutely plummet all the way down to $8,000 before they'd hit a critical failure point. Now, a lot of people heard that and thought, oh my God, that's a liquidation price. But is it?
So why isn't it a liquidation price? Well, it all comes down to how Strategy bought all this Bitcoin. See, they didn't just go out and get a standard crypto loan. They used a pretty sophisticated financial tool called convertible senior notes. And here's the absolute key. This kind of debt doesn't require any collateral. It's unsecured. And this right here shows you the difference perfectly. With Strategy's debt, their Bitcoin is what's called unencumbered. That just means no one can force them to sell it, even if the price crashes. It's a completely different world from a regular crypto margin loan, where your coins are held as collateral and boom, they get sold automatically if the price drops to a certain level. For Strategy, there is no margin call.
So if a big price drop isn't going to trigger a forced sale, what is the actual danger here? Well, the risk isn't about the price today or tomorrow. It's about time. For Strategy, the real danger is the calendar.
This timeline lays out the real pressure points. Right now, they've got a cash reserve of over $2 billion, which gives them about a 2.5-year runway to cover their huge yearly payments. But the first real moment of truth, that comes in September 2027. That's when the people who lent the money can start saying, hey, we want our cash back. That is the deadline everyone should be watching.
So, while Strategy itself seems to be in a pretty strong position to ride this out, you can't really say the same for everyone else. Their wild success created a whole bunch of imitators, and that's actually where the true risk to the system might be hiding.
A lot of these copycat companies, they're smaller, they have less cash on hand, and they're just way more vulnerable. They could easily get trapped in this really nasty feedback loop. The price drops, so they run out of cash, which forces them to sell Bitcoin, which puts more Bitcoin on the market, which pushes the price down even further, and the whole vicious cycle just repeats.
And listen, this isn't just me guessing. An industry heavyweight, Galaxy Digital, recently put out a report warning that several of these copycat companies are at a high risk of going bust. These are the players who could start a real domino effect of selling.
And we're already seeing signs that the easy money phase of this whole strategy is over. I mean, when a super savvy investor like Peter Thiel decides to sell his entire stake in one of these firms, it sends a pretty clear signal that he sees trouble ahead for these highly leveraged players.
So does all this mean a market crash is inevitable? Well, not so fast. Because while the risk from these weaker players is very real, there are some powerful new forces in the market that could act as a pretty big safety net.
Let's go back to that scary $8,000 number for a second. This chart shows why a drop that big is almost impossible. Right now, the cost just to mine a single Bitcoin is somewhere between $40,000 and $87,000. If the price fell all the way to $8,000, it would be so unprofitable that basically the entire global mining network would have to shut down. That's something that has never, ever happened.
And maybe even more important, just look at the demand side of the equation. The new Bitcoin ETFs have unleashed this just incredible wave of institutional money. BlackRock's ETF, just by itself, holds over $54 billion in Bitcoin. That represents a massive wall of buying pressure from long-term investors who look at price dips as a buying opportunity, not a reason to panic.
So, what is it that we're actually watching unfold here? Well, it's probably not the start of some systemic collapse. It's more likely a healthy and, frankly, necessary consolidation. You could call it the Great Crypto Shakeout.
This whole process really separates the weak hands, the over-leveraged copycats who bought in for the hype, from the strong hands like Strategy and these big institutional funds. What's happening is a transfer of assets from short-term gamblers to long-term believers, which in the end is actually really good for the health of the entire ecosystem.
All right, so let's just quickly recap the main takeaways. First, that $8,000 disaster scenario for Strategy, it's pretty much a myth. Second, the real risk is a domino effect from all those weaker copycat companies. Third, we've now got this massive institutional buy wall that should provide a pretty strong price floor. And finally, what this all points to is a healthy market shakeout, not a total meltdown.
Which really leaves us with one final massive question. Is this whole corporate treasury model a ticking time bomb waiting to go off? Or is its founder playing some kind of 4D chess on a level that the rest of us just can't see yet?